Lilly isn't facing simple problems, so we didn't build a simple strategy. The pressure is real. Competitors are moving, the market is shifting, and expectations are high. We dug deep into Lilly's business, the industry, and the competition. Every insight led us to one clear goal: make Lilly the market leader. What follows isn't just a recommendation, it's a path to dominate. Let's start with a recap of the industry analysis. Here is the comprehensive view of the Porter's 5 forces, but 4 insights stood out. Rivalry is intense. Market consolidation and patent cliffs are squeezing margins. Substitute pressure is rising. Generics, biosimilars, and non-traditional therapies are gaining ground. Partnerships are strategic levers. Alliances with tech and research players are opening new growth paths. Supply-side risk is real. Specialized inputs and upstream bottlenecks are inflating costs. Now, moving on to the PESTLE analysis. 1. Demand is rising fast. Aging populations and chronic diseases are expanding the global patient base, especially in emerging markets. 2. Technology is the game changer. Personalized medicine, biotech, and digital therapeutics are reshaping what innovation looks like and how fast it moves. 3. Regulatory and pricing pressures are tightening. With price caps, transparency mandates, and rising compliance costs, firms that can't demonstrate value will get left behind. So what does that mean for Lilly? The pressure is real, but so is the opportunity. The companies that will win are the ones that move first, partner smart, and innovate with focus. That's the lens we use to build the strategy you're about to see. Now let's move on to our competitors' analysis. Here is a quick snapshot of our 2 competitors. Pfizer is strong globally and known for its cancer treatments, but their profits dropped after COVID, and their new products aren't very different from others. AbbVie is focused on big areas like immunology and cancer. They're investing a lot and growing fast, but they rely too much on a few drugs and carry heavy debt. Since Pfizer is big but slow, we can move faster and innovate smarter. And since AbbVie is bold but risky, we should grow without taking on too much debt. Therefore, our edge is focus and speed. Lilly doesn't need to be the biggest, just the smartest. To make sure that our strategies are grounded in real success, here are the 5 key success factors. Innovation. Breakthrough R&D is the #1 driver. Regulatory skill. Navigating policy and compliance is make or break. Supply chain strength. Without reliability, everything else fails. Scalable access. Operationalizing access by reaching underserved populations. Consumer-centric engagement. Meeting people where they are and the channels they use with relevance builds trust and loyalty, not just awareness. We used these as our filter. Every part of our strategy is built to help Lilly lead where it matters most. So now we know what it takes to win in this industry. The question is, where does Lilly stand strong and where do we need to double down? Let's break down Lilly's core competencies using 4 lenses: financials, business model, value chain, and Rio. Financially, we're leading. Fastest growth, highest profits, best return on equity. Our margin is strong and we use capital well. What needs work? Cash flow and inventory speed. Our business model is built for innovation. We partner smart, focus on high-value drugs, and reach patients directly through tools like Lilly Direct. But we still need to push global access and payer alignment. Our value chain runs tight. From R&D to manufacturing to delivery, it's efficient, automated, and ethical. Still, we need to move faster as we scale. And from a Rio view, we have a real edge. Our R&D and AI tools give us a lead that's hard to copy. The brand is strong, the pipeline is solid. Now we double down and make that advantage stick. Bottom line, Lilly is built to lead if we keep moving with focus and speed. To give you the bigger picture, here's an integrated SWOT analysis pulled from the insights of the internal and external analysis. But what matters most is this: Lilly should double down on its strengths like innovation, R&D scale, and strong partnerships by leveraging market opportunities in digital health, emerging markets, and next-gen therapies. We need to fix our weaknesses, especially cash flow and global reach, by tightening operations and investing in smart scalability. And to stay ahead of threats like pricing pressure, regulatory shifts, and rising substitutes, we must stay aggressive on innovation, protect our IP, and move faster than the rest. Bottom line, build on what we do best. strengthen where we're exposed, and move where the market is going. Now that we've examined the big picture through the integrated SWOT analysis, we can get more specific. The competitive strengths assessment brings that broader analysis into sharper focus. It shows how Lilly stacks up against key competitors Pfizer and AbbVie across the areas that matter most in this industry. Rather than looking at individual strengths in isolation, this assessment helps us understand how they all add up. Lilly performs especially well in R&D. They invest over 24% of their revenue onto R&D, well above Pfizer and AbbVie. This positions Lilly strongly on innovation. They also lead an intellectual property portfolio. With more than 9,200 patents, Lilly's portfolio is significantly larger and better protected than its rivals. This gives it a clear edge in long-term product exclusivity. In supply chain management, Lilly shows strength as well, especially with its major U.S. manufacturing investments. These help improve resilience and reduce outsourcing risk. Financially, Lilly holds its ground with strong margins and return on equity, although it does face pressure from rising capital expenditures and relatively weak liquidity. But not every area plays in Lilly's favor. The company is behind in digital capabilities. Compared to Pfizer and AbbVie, Lilly lacks a centralized digital infrastructure, something that limits their ability to scale tech-driven engagement and internal operations. Their consumer engagement model also lags, especially through personalized digital channels. When we weigh all these factors, Lilly earns an overall competitive strength score of 7.58. That places it behind both AbbVie at 7.6 and Pfizer at 8.34. What does that mean? Lilly is strong in several core areas, especially innovation and intellectual property, but they aren't leading overall. The score reflects a competitive disadvantage when compared directly to its top rivals, and the nearly 1-point gap with Pfizer signals a meaningful difference in market position and capabilities. This gives us a clear data-backed view of where Lilly stands today, not at the bottom, not ahead either. It highlights where Lilly is most competitive and where there's room to grow. So how does Lilly's position translate into strategy? As part of our strategic analysis, we conducted a SPACE Matrix assessment, a diagnostic framework designed to quantify an organization's strategic posture by evaluating both internal competencies and external conditions. This matrix is built on 4 critical dimensions: financial strength, capturing our financial performance, cash flow health, and capital availability; competitive advantage, assessing our cost structure, brand strength, market share, and innovation edge; industry strength, evaluating the attractiveness of our industry in terms of growth, demand stability, and barriers to entry; and environmental stability, measuring external volatility such as market uncertainty, competitive disruption, and regulatory pressure. Lilly scores positive 1.8 on the x-axis thanks to a strong market position and solid competitiveness, even with some cash flow and liquidity challenges. On the y-axis, we land at positive 1.0, driven by strong margins and innovation, though tempered by a fast-changing and highly regulated market. What does this tell us? Lilly sits firmly in the aggressive growth quadrant. That signals a clear strategic intent. We're not playing defense. We have the internal strength, market position, and industry tailwinds to push forward to grow, invest, and lead at scale. To determine where and how to focus that aggression, we applied the Ansoff Matrix, a proven strategic planning tool used to evaluate growth options across 2 axes: products and markets. We've rigorously evaluated 4 growth alternatives of the Ansoff Matrix using a weighted scoring model. The goal is to assess each option's alignment with our business priorities and determine where to focus our efforts for maximum ROI and strategic leverage. We assessed each alternative, market penetration, product development, market development, and diversification across 4 weighted criteria: strategic fit 20%, risk profile 20%, speed to impact 30%, and capability to execute 30%. Each criterion was scored on a relative scale of 1 to 4, with 4 representing the strongest alignment with our objectives. Here are the total weighted scores. Product development leads with a 3.7, driven by high alignment across all 4 criteria, particularly speed to impact and strategic fit. Market development comes next at 2.5, showing moderate potential with some executional and timing trade-offs. Market penetration follows closely at 2.4, offering lower risk but limited growth. Diversification ranks lowest at 1.2 given its high risk and weak fit with our current capabilities. Therefore, the challenge now is, how can Lilly turn its innovation strength into scalable, differentiated growth by capitalizing on digital, patient delivery, and global opportunities to achieve market leadership? This boils down to 2 strategies: product development or market development. First option, Product development. This plays to our core strength, innovation. We're already leading in R&D scale and scientific talent. What we need now is to extend that edge by building digital health platforms that complement our existing therapies, scaling AI across the enterprise to accelerate development and reduce cost, and entering next-gen therapies, gene editing, mRNA, cell therapy with a phased de-risked model. Second option, market development. This strategy targets volume and reach, particularly in emerging markets where aging populations and chronic disease are surging, and local regulators are hungry for partnerships. To choose between product development and market development, we return to the competitive strength assessment, the most direct measure of our relative advantage. The gap is not access, it's value delivery. Pfizer leads not because of reach, but because of digital infrastructure, brand, and engagement. The issue isn't where we sell, it's how we package, deliver, and differentiate our products. Scaling underperformance globally only scales underperformance. And although market development can extend our presence, it cannot fix those foundational gaps. This brings us to our final recommendation. After a rigorous analysis of internal capabilities, external pressures, and competitive dynamics, our strategic direction is clear. We recommend product development as the primary path forward, which is fully aligned with the aggressive growth strategy. Why product development? First, it builds on Lilly's strongest asset, innovation. Second, it directly addresses critical capability gaps, digital engagement, patient delivery models, and global brand reach. Third, it enables us to generate new revenue streams, differentiate from commoditized competitors, and scale faster with lower risk. The market is shifting. Competitors like Pfizer aren't moving on digital. AbbVie is doubling down on high-risk verticals. We don't need to outspend them. We need to out-execute them by prioritizing digital health ecosystems like Lilly Direct, scaling AI and automation enterprise-wide, and investing in next-gen therapies through phased, capital-smart models. Now let's discuss these initiatives one by one. First, digital health ecosystem. Why start with digital? Because it's our biggest gap and our biggest opportunity. We're behind in digital health, but that gives us a chance to outskip outdated models and build something better from the ground up. Early estimates show a 20 to 30% return driven by stronger patient engagement, improved payer outcomes, and new revenue from digital services. Based on case studies from Accenture, Deloitte, and IQVIA, digital health tools improve patient retention and outcomes, leading to improved formulary placement and recurring revenue models, particularly in chronic care and specialty pharma. We'll begin by expanding Lilly Direct, adding wearable integration and AI-based coaching to create a more connected care experience. Second, AI and automation at scale. AI is already working in parts of Lilly. Now it's time to scale. We'll apply it across the value chain from drug discovery simulations to automated manufacturing. Industry benchmarks from McKinsey and BCG suggest AI can reduce development costs by 20 to 40% and speed up R&D cycles by 15 to 25%. This isn't experimental. It's a proven, low-risk transformation that boosts both innovation capacity and margin efficiency. Third, next-gen therapies. Gene editing, cell therapy, and mRNA are shaping the future of medicine. We have the R&D muscle to lead, but the capital and regulatory runway is longer. We treat this as a phased co-investment model. Early wins will win from licensing and joint development. The upside, a single asset here can generate over $1 billion in peak sales, reshaping our future portfolio. We've mapped a 3-year phased rollout, focused, realistic, and built for scale. 2026 build. We'll launch pilots, digital health, AI and R&D, and next-gen therapy groundwork. 2027 scale. What works, we scale. We'll expand digital care, automate operations, and move gene and cell therapy into trials. 2028 lead. Fully operational. We aim to lead in digital patient care, AI-powered drug development, and next-gen innovation. To stay accountable, we're tracking performance across 4 areas. First, financial. We're targeting 10 to 15% revenue growth from new platforms like digital health and next-gen therapies, $1 billion in cost savings driven by enterprise AI and automation, and a 50% increase in pipeline value, making sure what we build today drives returns tomorrow. These metrics ensure we stay profitable, efficient, and investor-aligned. Second, customer. We aim to reach over 100 million patients globally, especially in underserved markets, achieve 75% or higher satisfaction in our digital health services, and close at least 10 outcome-based contracts proving our value beyond the pill. This turns patient impact into real loyalty and payer trust into competitive advantage. Third, operations. Our focus here is execution. Cut drug development time by 25%, deliver 99% supply reliability because availability is non-negotiable, and launch 5 new therapies by 2028 across both traditional and next-gen categories. We're measuring speed, scale, and delivery. Last, people and technology. For the strategy to work, Lilly's workforce needs to evolve with it. We'll train 50% of staff in AI and digital skills, achieve 95% integration of enterprise data systems so decisions move as fast as the science, and hit 80% adoption of key strategic programs across the company. Execution is where strategy lives or dies. That's why we've embedded go or no-go triggers. If digital health NPS is less than 60 in year 1, shift to B2B partnerships. If AI adoption is less than 20% staff by year 2, reallocate to vendor-based automation, and if R&D milestones is less than 50% by year 3 in next-gen, refocus on licensed assets. These aren't fallback plans, they're risk governance tools to keep execution accountable and capital smart. This is more than a strategy, it's the start of a transformation, built to outperform, built to scale, and built to last. Let's lead forward.